A huge sell-off on the Australian share market today has wiped $23 billion from the value of local stocks as fears of a new global recession buffet world economies. The Australian spiral follows a similar slump on American markets over the weekend. That was sparked by grim new employment figures suggesting the American economy is faltering. The silver lining is another expected cut to official interest rates when the Reserve Bank meets tomorrow. Greg Hoy reports that the weakening Australian dollar is also bringing some relief to exporters and retailers.
Disappointing US jobs growth figures saw the Dow Jones index fall to its lowest level in 2 years on the weekend, further spooking Australian investors who've already seen $100 billion wiped from the value of the local market in the past month.
Basically, it was bad news coming in threes. We already know that the European economy is in recession, worried about how deep it's going to go. We then recently got some purchasing manager data from China indicating that they are going through an economic slowdown. And now with the jobs report being substantially weaker than expected, investors are now wondering how wide and how fast could the economies around the globe go back into recession.
The share market is reacting to sharp falls in European and US share markets that we saw on Friday, and that of course came on the back of much worse than expected jobs figures out in the US, all at a time when investors around the world are worried about Europe.
Similar sentiments have diminished the standing of the Royal Gold Aussie dollar, which is actually an aluminium bronze alloy, and which fell to an 8-month low of 96.38 cents US earlier today. The dollar had already been knocked off its perch above parity with the US greenback recently. The fall following fears over the faltering global economy and Greece's looming election that will decide if it stays or leaves the euro, defaults on its debts and slides back into the social unrest seen in recent years.
There is a general scare in the capital markets. We've seen stock markets sell off and we've seen the currency market sell off at the same time. Capital is flying into the bond market looking for safety. I wouldn't expect to have a defined bottom in place until after the Greek election, which is on the 17th of June.
By rule of economic thumb, a 1% fall in the stock market generates a 0.5% fall in the dollar in the same month. But while investors may be weeping, manufacturers and exporters like Australian beef producers are over the moon.
Can I say, Greg, dancing in the streets?
Richard Rain's company, Sanger Australia, is the nation's largest exporter of Australian beef.
A 1 cent move in the Australian dollar against the US dollar equates to about $50 million to the red meat industry. So I don't have to tell you what a difference this fall in the Australian dollar has made to the beef industry. It's substantial and we're seriously enjoying it.
But the multi-billion-dollar question is, will this relief last?
I think it will be like the fall in the Aussie dollar we had last year. It was a short-term sell-off. It'll bounce from this as it bounced last year, and we'll be back towards fair value, which is currently north of $1.
Unless, of course, Greece leaves the euro, defaults on its debts and triggers a domino effect through other heavily indebted European nations.
What we could potentially get initially is the first phase of the crisis where we'll get what I'd call a 3-country contagion, where Ireland and Portugal consider going the same way as Greece and markets start to price for that possibility. Under that environment, you'll see the Australian dollar dip down towards 90 cents. But if the crisis enters its more serious second phase and we get what I'd describe as a 5-country contagion, where Italy and Spain join the other 3 countries, you'll see some serious market pricing, downward pressure on global share markets, such that the Australian dollar would begin to fall below 80 cents and towards 70 cents.
It's really important we keep all of this in perspective. We face these challenges from a position of strength. We've got solid growth, we've got low unemployment, we've got a healthy financial system, we've got strong public finances, and we've got a huge investment pipeline.
Despite the government's optimistic mantra, The gloom seems contagious. House prices, according to the Australian Bureau of Statistics, have fallen 6.1% since their peak in 2010. And you only need to ask around amongst retailers to gauge the continuing fall in consumer confidence, even in the face of relentless discounting.
Once you start conditioning people to wait until you devalue your product, you're in massive trouble. There's a lot of despair out there. A lot of people have been burying their debts, burying their mistakes, and it unfortunately is catching up with a lot of people. The gap of debt to turnover is just getting wider and wider for many.
So as the Reserve Bank Board gathers tomorrow, it faces mounting pressure from right across the economy to further reduce interest rates, to boost flagging consumer confidence and maintain downward pressure on the Australian dollar.
The reality is that the global backdrop is far worse than the Reserve had assumed even just a month or so ago. Worries about China, worries about the US coming on the back of already existing concerns about Europe. And then, of course, we've seen a run of weaker than expected economic data in Australia for retail sales, house prices and so on. The list goes on. Bottom line is that the Reserve Bank needs to get ahead of these concerns. Otherwise, we'll see a sharp slowdown in the economy, and we think, therefore, they'll be cutting by 0.5%.
I mean, everyone now is an economist, right? You can't open the newspaper without some sort of economic commentary. And that's not going to go away, and confidence is a long way off.
And later this week, new unemployment and economic growth figures will give us further insight into how the Australian economy is faring.